we are going to be, we're very, very fortunate to have with us Dorothy Jumba, who's head of customer experience of the HF Group in Kenya. Dorothy is going to talk to us about shaping and defining personalized and effective customer experience. And I think that we know, and certainly we've learned through the day, that to achieve anything vaguely close to the sort of level of customer intimacy that we need in financial services requires cross-functional customer teams armed to the teeth with data and insights to help simplify complex financial needs of our customers. So Dorothy, we're really looking forward to your presentation. Over to you.
Thank you so much, Louisa, and welcome everyone to today's presentation. Yes, as Louisa introduced me, my name is Dorothy Jumba. I take care of customer experience at HF Group. HF Group is one of the banks that we have in Kenya. We were predominantly a mortgage house, but started to do commercial banking. And we're very, very, very excited about it. We're excited about the kind of experiences that we can create for our customers, and just to see them take up the products that we have and the services that we have, and just be able to use them. That truly makes us happy. So I'm going to take you through a topic that Louisa has talked about. I've tweaked it a little bit just so that I can be able to address the changes that have happened. With COVID, a lot of things changed, business as usual, completely. So I wanted us to just walk that journey on that, how that change was. I'll focus quite a bit on Kenya, and then we'll also be able to just see how that touches on other parts of the world here and there, and just the kind of experiences we've been able to create for our customers in that whole situation. Allow me to project. So one of the things we wanted to look at, even as we look at the experiences that we were shaping, and how that was completely redefined for us, and I asked myself a few questions. So one of the questions I asked myself was, and which I would want to answer together with you as my audience: how are the banks able to continue to meet the demands of the financial transactions in the face of the pandemic? So there are a few things, a few changes that had to be made during that time that also helped us to redefine and change the way customers were interacting with us, and the way customers were interacting with money, and the way customers were interacting with other service providers. So one of the first things that the Central Bank of Kenya is the body that regulates banking within Kenya. So one of the really first things they did was actually to give guidance around the mobile transaction fees. So what normally happens from research, we realize that almost 60% of the transactions that happen on a daily basis are for values between 0 to 1,000 Kenya shillings, which is an equivalent of about 10 US dollars. And each of those transactions attract a certain fee on them. And that's the money that moves the most within the economy on any given day. So what Central Bank of Kenya did was to be able to give concessions, to request banks to give concessions to customers and not to charge those transaction fees. So this was going to cushion especially the SMEs who use the platforms the most to make intraday payments. The other direction that we got around this, and which the banks were able to implement, was around the call for cashless transactions. So this meant that a lot of the banks had to step up and up their mobile banking solutions, or any of the other digital solutions that we have, mostly around mobile banking, and I'll talk a little bit about that a bit later. So there was the call for customers to go into cashless transactions, because we all know that the whole issue around touching money at that time was a very serious way of actually being able to pass around the virus. So the third thing that banks also needed to do immediately was to decongest the banking halls. Now, one of the customer behaviors we have a lot in Kenya, people like face-to-face. People like to engage with other service providers face-to-face. So our banking halls were always full of people seeking one service or another. So the banks were called upon again to find a way of providing other than cashless transactions, to find other ways of sorting out customer issues other than face-to-face. So this took a lot of innovation around looking at the existing processes, looking at the existing services that we had, and just trying to see what we could automate as fast as possible and be able to give customers this service on a digital platform. The other thing that needed to happen, and to happen almost immediately, was to increase the daily ceilings that we had around mobile banking. So as I mentioned, central bank guided that on the relief around the mobile banking fees that were charged for the small transactions of up to about 1,000 bob. Each of the mobile transaction mobile platforms normally has a ceiling within which a customer can transact. Of course, that is regulated as well, and that helps us to track and to just guard against money laundering. So what CBK did again was to give us a room to expand our ceilings so that customers could transact more without needing to come into the bank to get money or into the ATM to be able to get out money. The other thing that we did as banks, again guided by customer feedback and guided by the information that we had within the market, was around loan restructures. So a lot of the SMEs that we had and personal banking customers, we were able to give them loan holidays through loan restructures for quite a bit of period within 2020, just to cushion them and to give them some room for their businesses to pick up again and enable them to be able to make their normal monthly repayments. So loan restructures were done, and this actually helped us to reduce the non-performing loan book because we were able to cushion our customers during that time when they really needed that. So as a result of that, towards the end of the year, Kenya Bankers Association, which is another association for banks within Kenya, conducted a survey amongst our customers just to find out how they felt supported by their banks that they bank with in terms of supporting them during that period. So 92% of the respondents, of the customers who responded, actually appreciated that they were able to get the digital banking platform for them to use, and that then made it not necessary for them to actually come into the banking halls or to go into the ATM to be able to get out cash. So what was the effect on customer behavior? All those initiatives that I've talked about on the first slide. According to that same survey, the customers who preferred the mobile banking solution that was being offered by banks was 79% of the customers. So you can see quite a big chunk of our customer base actually shifted to mobile banking during that period, 79%, compared to 21% who were on internet banking. And I think these had a lot to do with access to mobile phones, access to and the mobile penetration. For internet, most of the time you have to be on a PC for you to be able to use it very effectively. So for the mobile banking, since most people actually have access to the mobile phone, they were able to use the mobile phone, and the population actually using USSD was even higher than the population that was actually using the apps, because for the app, you then need a smartphone. When we looked at some of the factors that influenced which channel of transaction they preferred, we actually zeroed down on about 5. So one was around convenience, one was around the efficiency of the platform they were using, the ease of using that platform, whether it had user-friendly interfaces, and of course the security aspect of it were very key to our customers during that time. So then, just looking at all this, we also wanted to look at the support channels that were given for customers during that time. How did that affect how the customers were using the products and the services that were being offered by the different banks? So the other area we looked at was around our contact centers. So we've looked at the walk-in customers within the branches and some of the processes that we had to tweak to make sure they're able to support our customers. We also looked at the contact centers. So one of the things we noticed immediately, almost immediately actually, was an increase in traffic within the contact centers. So even the contact centers that were previously not running 24/7 had to now up their game and open up and now run 24/7. Customers were now working from home. So the pressure was more now on the channels that were either on phone, the non-physical channels for customers to be able to get help. So we immediately saw an increase in the demand into the contact centers. And for most banks, we even had to hire. So it was an opportunity to actually increase the staffing levels for us to be able to meet those demands. However, you cannot hire endlessly. So one of the things we needed to do was to divert some of this traffic from voice, because it was predominantly voice initially. So we had to divert the traffic into what we were calling the alternative channels of support. So this was around SMS, we had social media, we had email, we had WhatsApp chat, we had web chats, and we even had chatbots. So a lot of these solutions, some of them really had to be done in a rush, because some banks did not have these alternative channels, or possibly had one or two, and they had to quickly build alternatives, integrate them as fast as possible into their existing solutions, so that they could be able to serve the customers almost holistically, to have a fast call resolution of sorts from these customers. So for that to be able to be done and to be done well, a lot of the banks had to source for omnichannel CRM solutions that would enable them to integrate the voice, the call routing system into the CRM, into the core banking system. So that way, then you'd be able to get a 360 view of the customer when they called, the kind of products they have, the kind of channel they prefer to transact on, the kind of channel they prefer to get help on, their demographics, age, income. It was actually quite nice to be able to see all those features of the profile of the customer. So it made it so much more easier to serve them. And I think because of this, we've also, even after the branches were reopened and people were given the go ahead to go back, the volumes have never increased back into the branches, the footfall, because customers are still now able to get help online through contact centers. So in addition to that, there was huge demand for self-service solutions. So again, we had to do a lot of customer training and education, because I think human beings, at least in Kenya, don't like to talk to machines. But with good solutions, with simple solutions on the IVR, solutions that actually work, we were able to divert quite a bit of traffic into the IVR as well. Now, all the above solutions, together with the initiatives we had initially, were largely premised on technology. So there was a lot of technology that had to be invested for these things to actually be brought to life. So how did technology facilitate the innovation? Because again, a lot of innovation had to come into how the customers would be served based on their changing circumstances, based on their changing preferences. Customers began to call us more in the evenings, because now we realized they are working from home during the day. So evenings after work is when now they were able to call us more. So it called for a lot of innovation in how to serve these customers and not to drop calls, and just to be able to give them the kind of solutions that they were now seeking as compared to what they had before. So a lot of innovation happened. A lot of it was premised on technology. There is a report that was done by our regulator. It's called the Banking Sector Innovation Survey Report, for a survey that was run in 2020. And from this survey, one of the things that we realized was that 79% of the banks during that period actually introduced a new fintech product between January and December 2020. And based on the information that was gathered, a lot of these products were facilitated by APIs, big data, analytics and investment in systems that could do good analytics. Cloud computing was big time. And this drove innovation and acceleration of digital strategies as opposed to CAD. So previously, a lot of strategy had been around CAD penetration and all that. But with this now, focus sort of shifted, because now we needed to do digital solutions that would get to the customer at their point of preference, whether at home or in the office, and needing them not to live there and be able to do whatever it is they wanted, the transactions and all that. So this was technology supported us with regards to the CRM that I've talked about, and being able to give us those omni-channel solutions and tons of data that we're actually able to just study and understand the customer holistically, and even change and fine-tune some of the products that we have to be able to fit into those profiles that we were now seeing. There was also a lot of accelerated growth in the mobile banking platforms. So there are banks that just had the app. There are some that just had the USSD, but now they had to create some really robust solutions around mobile banking. And for this, for customers, again, based on that data that we were able to get from customers and based on constant interaction with customers and customer feedback, we were able to get their preferred channels. So a lot of development went into the app. What do customers want to do with the app? What do they want to do with the USSD? So we're able to put in a lot of solutions into this platform. We were even able to come up with the solutions like WhatsApp banking, because customers were on social media a lot. They were on WhatsApp a lot. So it makes sense to give them a solution, that a banking solution that will actually sit on their channel of preference of communication. So WhatsApp banking came up quite a bit during that time, and a number of banks have launched on that. In HFC, we launched WhatsApp banking a little bit earlier in 2019. We were able to launch WhatsApp banking, but in 2020, based on customer data, we were able to improve on it quite a bit. Now, a lot of all this, number two, accelerated growth in mobile banking was facilitated a lot by number three, partnerships with fintechs, what the central bank report was talking about, and other service providers. So for fintechs, I think this was a time when we had the largest amount of partnerships created, because working with fintechs then means you're able to shorten your time to delivery, as opposed to the normal bank processes that are usually quite lengthy. So it meant when you partner now, you're able to shorten the turnaround time and deliver products and services to customers faster. You're able to get into a wide array of products and services that you probably would not have been able to develop as a bank. We were able to leverage on the expertise that exists amongst the fintechs, and also leverage on their resources. So what this meant then, we were able to create very robust apps. For instance, the app we have in our bank is integrated into almost every service that you can think of. We integrated into electricity payment, water payment, pay TV, literally anything that you can think about, into M-Pesa, and I'll talk a bit about M-Pesa. That has also helped us to really reach out to the population that we have. So one of the other partners that we have that has been very robust is the government of Kenya. The government has provided a lot of platforms where we've been able to integrate as banks, and that has really helped us to be able to do things like KYC, know your customer, really well, and at a go, at a touch of a button. You're actually able to tell who Dorothy is, what my personal number is, what we call the national ID number. You're actually able to tell all that. So if it is issues about onboarding, or if it is issues about if you want to give a mobile loan to a customer, you're actually even able to integrate into the credit reference bureaus, and at a touch of a button, you're actually able to pre-qualify, analyze, and see whether this person then fits the kind of service that they are seeking for. So partnerships have been very big for us, and I think even for most organizations, given that this was part of their strategic objectives under the sustainability development goals, which talks about partnerships, that should be around number 15. This has then helped us to really plug in really well into that agenda. Integration with M-Pesa, number 4. M-Pesa is a mobile payment solution that we have in Kenya, supported by one of our mobile networks, MNOs, called Safaricom. And what this has done, I think in Kenya, it's really revolutionized our financial access to financial inclusion. So even the non-banked are able to access money and mobile money through M-Pesa. So what banks have done, we've been able to integrate into M-Pesa. Actually all the banks are now integrated into M-Pesa. And what that means, it then becomes so much easier to move money from your from your bank account into your mobile wallet. And now you're able to move the money around even to other people who may not have a bank account. So that made it easier for us to go cashless even as a country, because we had other platforms that were able to do that for us. So integration into M-Pesa has also helped banks quite a bit. And again, we were trying to fit into the customer lifestyle, because the customer lifestyle has M-Pesa integrated in it quite a bit. Then we were simply just fitting into the new way of life that the customer has, and being able to deliver service to the customer in the channel that they know and in their channel of preference, if I could say that. So what are some of those disruptive innovations then that facilitated these changes that we're talking about in customer experience and that have driven and shaped the customer experiences that our customers have? The first one, I've called it the magic of the cloud. Now, cloud computing has had come before this period, of course. However, in 2020, it just helped us to completely revolutionize a lot of things that we were doing during that time. So for one, it helped us to really do a lot of remote development. So remote development of products, our developers could sit anywhere and be able to work on the products that we wanted, together in partnerships with the fintechs that I've talked about. And we were able to deliver very, very many products during that time and very fast. So go-to-market time was really reduced, and we were able to churn out products into the market really, really fast. And again, cloud helped us to reduce on investment in IT and infrastructure. So we didn't have to buy servers and all that. So that helped us with the cost containment during that time when everyone was trying to get their costs contained. And also in terms for now, for the benefit, the direct benefit for the customer, scalability was very easy. So scalability was on two fronts. One, for our product, we were able to work on them really fast and get them out. But also during this time, because we were pushing customers into the digital platform and away from face-to-face, our mobile banking customer base exponentially grew. So that meant we really needed to scale up really, really fast to be able to give our customers the same experience they were getting even when there were not so many on that platform. So the magic of the cloud worked for us at that time, and we were able to scale up really fast and give our customers a seamless experience without them having to know that we were now scaling up or stretching really, really fast. So the cloud really was instrumental in helping us to just shape our customers' experiences during that time. There were other solutions that we were able to give to our customers who, remember, we were not supposed to come into the bank. So we were able to give them things like account opening. Previously, account opening, customers would have to come and line up and fill physical forms, attach paper, documents that we needed. But now with this new capability and with the partnerships we had into the government databases of people and registration, we were able to offer an end-to-end account opening experience on the app, or even on USSD, or even on WhatsApp banking. So customers would be able to just attach the documents that we needed. We were able to do a background check and be able to do and open an account for the customer. So that was really a really good experience for our customers, for them to be able to open accounts without having to come, especially for the personal banking customer. And then we also, that same period, we had a lot of bots, and what the bots then helped us to do was to reduce or to handle the back office traffic. So some of the bots that came up during that time were able to handle some of the mundane requests that come all the time, account balance, and simple requests from customers that can be handled in an automated way. So for some banks, the bots were able to handle even up to 30% of the queries that were coming in from customers. So that of course, for the benefit for the customer was that the turnaround time on their issues was almost instant. And that was a good experience because we didn't need them to come. We wanted to decongest the calls into the call center, and we didn't want them to walk into the branches. We wanted them to be able to serve from where they were. We were able to also scale up on the credit scoring. So a lot of banks, banking solutions have loan modules where they're able to give loans to customers. And of course, credit scoring then helped us really big to be able to analyze and pre-score customers and give them limits, loan limits that they could be able to access. So that again speaks into the financial inclusion agenda where customers could get loans. Those who could not qualify for a traditional bank loan where you needed to walk in with a lot of paper, we were able to give small loans, especially to our SMEs, using the mobile banking solution, which was their preferred channel of transacting. So together with all this, we had people who are working from home, our customers who are working from home, and ourselves as well. And this again was facilitated by technology, just being able to get people to work remotely from where they are and support customers remotely. So we used a lot of the collaborative tools that we currently have, either based on Microsoft or Zoom or any of the other platforms. And we were able to reach our customers and have seamless interactions as if we were face to face. So if it was a relationship manager with their customers, they were able to have those conversations. So that meant that banking did not stop. But the difference is the customer is not inconvenienced. We actually are able to meet them and talk to them during from wherever they are. And this especially really worked for us, for our customers who are in the diaspora, who are on different time zones from us. So that really, really worked well for us. Now, every good thing, I would say, comes with also its own challenges that we have to look out for and find ways of mitigating. So all those things that happened and still continue to happen even now, even on a bigger scale, came with certain things that we needed to look out for and just keep a close eye on, because they could potentially damage either the brand or even affect the customer in one way or another. And the biggest for us was around cybersecurity. And this was actually across the industry. Because of the partnerships we had, because of the integrations that we had, there was always the risk of cybersecurity. So we were looking at it from different angles. One is around the new products that we had. So we had to look at how are those products, the integrations that we have with our vendors or service providers, how secure are those API connections, how secure are all those integrations. So cybersecurity was big in that angle. Then we also looked at the hybrid workforce that we had. So we had teams that were working sometimes from the office and sometimes from the home. So with the home working and all that, again, that whole space of cybersecurity has to be looked at. The secure connections from home, the home Wi-Fi that people were using, and the systems that needed to be protected, the bank systems that needed to be protected. So cybersecurity was a big one that we had to look at and still continue to look at, because I think where we've taken off from, we are not looking back. We are going digital. A lot of things are going to be out there digital going forward. So it's something that we really want to look at. The other one was around data protection. Again, we now have a lot of data that we are reading into for our customers. We have integrations with third parties. We need to protect our customer data. There are data protection laws. In Kenya, there is a Data Protection Act that stipulates consumer rights and that whole space around data protection. So we also just had to keep a keen eye on it and just see how then, as we work in all this, as we innovate, as we use technology, how are we going to ensure we actually have data protection? The other one was around consumer education on financial literacy. So we had customers who were, as I'd said initially, had probably never used mobile banking, had never used internet banking. So a lot of education had to go into that to get our customers to use that. And as we are busy trying to educate our customers on financial literacy, there are guys out there who are trying to find ways of doing social engineering to con them. So we also had to do a lot of education around just protecting your data, your information, and not giving out that information to people who want to fish that information either online or through the mobile phone, for our customers to just remain secure even as they transact in the platforms that we have given them. The other one was around fast-tracking approvals for innovation. Traditionally, I think banks have very long processes, and products needed to be churned out really fast, and customers were asking for more and more. So that meant we could not continue with the business as usual in terms of the lengthy approval processes that we had. So this had to change and make sure that we're able to do it faster so that we could roll out more products. And this also touches on review of the processes, internal processes and procedures around the products that we had. A lot of the products changed. during that time because of the mode of delivery and because of the way the customer wanted them. So it meant a lot of changes around and continuous improvement around the processes and procedures that we had so that we could be able to deliver a relevant product to the customer based on what they wanted. And then the other thing that we kept an eye on, and which also the regulator kept guiding the banks, and they still do, is policy guidelines around digital lending. Because now that we've been able to lend to customers on the mobile platform, of course, there are all those things that you need to look at just to make sure that you remain afloat. I think digital lending, if done badly, can actually wipe out your liquidity. It can wipe out the money that you have. So you really have to have some really good proper guidelines around digital lending. So those are things that all banks keep looking at and just making sure that we are safe even as we give out loans to our customers. So we're able to do very good credit scoring, you're able to do very good profile analysis of your customers, and all that is premised on data. So a lot of data came out of all this that has helped us to be able to tighten here and there on the things that we do. Then finally, maybe just to wrap it up around cybersecurity, I think one of the things that the regulator gave us out of that survey that was done on banking sector innovation was that cybersecurity actually consisted 35% of bank concerns. And that's valid because of the changes that were happening during that time. That was even higher than the risk they felt around strategic risk and operational risk. So that just went to emphasize to us the areas of priority that banks were putting in place, even as they churned out on products and services that they had. Yes, that's what I had prepared for you today. Thank you so much. Yes.
Dorothy, thank you. That was an incredibly detailed and powerful presentation. Thank you very much, and we'll see you next time. Bye.
Thank you.